Taking stock of the real estate capital markets can be a tall order right now. At this volatile moment, it's invaluable to hear insights from an executive who's been there and done that through multiple market cycles. Hello, and welcome back to Investment Matters. I'm Paul Rosta. Toby Cobb is a 30-year industry veteran and the co-founder of 3650 Capital, a diversified lender and loan servicer. Previously, as co-CEO of LNR Property, he built the loan origination platform and led the company's restructuring and eventual sale. At Deutsche Bank, he served as managing director and co-head of U.S. commercial real estate. In part one of this special two-part episode, you'll hear Cobb's frank insights on what it takes to get projects financed today, the prospects for interest rates, and the tale of three neighboring office buildings in Midtown Manhattan. Take a listen. Toby Cobb, welcome to Investment Matters. It's really nice to have you here today.
Thank you, Paul. Delighted to be here.
Well, first of all, I'd like to tap into your expertise in the capital markets. What does the big picture look to you right now as we speak? What are the key factors that will be most likely to influence the cost of capital and lending opportunities this year? What are some of the main trends that you're going to be watching?
Right. So, I think probably if we back up and talk about timeframes, right? We rolled into this year with a fairly optimistic view of having a Trump White House, right, an administration, and an economy that looked pretty certain to avoid the hard landing. And it is obviously the case that we have entered into a time of much greater volatility, and markets abhor volatility. And so, I can't suggest for a moment that things are today as they were just 2 months ago, right? But what I can say is that I'm not a big Trumper, so I'm not going to advertise for Trump and the Trump administration, but I'm also going to say that I am a fiscal conservative and believe, frankly, that our unwillingness to address the long-term challenges associated with $37 trillion of debt in America, right, was the kind of existential threat to our economy and to our country that had to be addressed. And I do believe that there probably has to be a more holistic solution in the long run, right? And it probably includes both the untouchables, which, I think everybody's saying, Medicare, Medicaid, and Social Security are the untouchables. And I think that's probably not necessarily realistic anymore, right? But also, frankly, on the revenue side, right? And so that's not a very popular position on either side of the aisle. But I think, frankly, it can't get done until we do break some things. And so I'm probably as concerned as the next guy with the volatility, but I'm also, frankly, pleased that we are taking some action in an environment that just could not possibly continue to go on the way it was going. So, that's a big global view from a fairly centrist perspective. And so, that being said, the credit markets always seem to be, for us, the most rational place to look for real markets, right? The equity markets can tend to be a lot more volatile, but the credit markets continue to function, right? And specific to commercial real estate credit markets and the commercial mortgage-backed securities market, it seems to be functioning well. Spreads have widened 15, maybe 20 basis points in the face of this volatility, but multiple billions of dollars of securities have been priced this calendar week, right? And so, I'm confident that the broader trend of commercial real estate credit, right, and the desire to put money out in commercial real estate credit in alts broadly, right, continues to be the case. And frankly, that's a theme that I don't think we can escape even given light of the volatility that we're seeing brought on by a Trump administration and a Doge that is fully intent on breaking some things before we start fixing.
Well, how about something else? It's been a huge topic of discussion for a few years now. Do you think that the Fed is going to make any interest rate moves this year, given the volatility that we're seeing? And if you do think that some moves are in the future, would you mind speculating on about when that could happen, or whether any possible moves by by the Fed would be on the small side, on the larger side?
Well, I guess I would say first and foremost that we as an organization would not suggest that we have a crystal ball on rates. And frankly, anybody who does would be a multi-trillionaire because, rates have consistently proven to be unpredictable, right? That being said, I would say that our chief investment officer, chief strategist is Justin Kennedy. He's been my business partner for 25 years. And I'd say that he is about as prescient an investor as exists. He is clearly, one of, if not the most prominent call of the onslaught of the global financial crisis. And at Deutsche Bank, avoided much of the real challenges because he hedged our book starting in 2005. So he's a very, very thoughtful, long dated, prescient investor. And Justin has been calling for higher for longer for a long time. Right? And the thought that we don't have an administration that is leading into areas that will be inflationary, like tariffs, right, and like immigration, right? I think those are realistically going to keep us higher for longer, right? And so I guess I would say if that's the case, then a response from the Fed in the immediate or the near future, we believe would be unlikely, right? And so get used to it. We're going to be in higher rate environment for longer, and then the other side of that is that we're not really actually in very high rates with respect to long-term rates, right? With a 430 10-year, right? We're actually in a rate environment that is relatively stable and somewhat benign. So it is just that we went through such a long period of such low rates that everybody, I think, frankly, just got used to much, much lower rates, and maybe they shouldn't have, right? I mean, there should be a cost of money. There should be a real cost of term money. And so if anything, I think we're going to see a steepening, right? So maybe the front end comes down a little bit, but I wouldn't really count on the back end of the curve doing anything but staying or even maybe rising.
That's just a very good reminder that a lot of the perception out there today really is a matter of relativity, right? Just the change from what was the case for so long.
That's right. And frankly, I think that it is that component that is making this, we always say that the four most dangerous words in investing are "it's different this time." Right? And that being said, we certainly are not seeing commercial real estate be the principal lead to a economic crisis, right? That is existential and warrants a response, an accommodative response from the Fed, right? And so if you look back at, the pandemic and the global financial crisis and the resolution trust era and the savings and loan crisis, the Russian debt crisis, like all of these cycles in our investment lifetime were also coincident with a very accommodative Fed, because commercial real estate broadly was overlevered, and it was taking us broadly into and it was chalked into the banking system, and it was taking us into fearful places of unrest and unknown. And so the Fed turned and was responsive to the broader economy and the need to generate investment, and all of that was frankly accretive to long dated hard assets like commercial real estate, right? And quote, save the day, right? Today, we probably have the best capitalized banking system in my career when looking at any kind of volatility, right? I think there's, plus 15% tier one capital in all the top 50 banks. And I'm not a bank analyst, and so I don't want to suggest that I know everything that's happening, but I certainly pay very close attention to what's happening in the banks because they're the principal provider of credit to commercial real estate in our industry yesterday, today, and likely tomorrow, right? And there's going to be some caveats to that as we get deeper into what's happening in alts credit for commercial real estate. But the banking system provides as much as 50% of all commercial real estate credit, right? And the banking system that matters in the United States, which is top 50 banks, the SIFIs, they're all healthy. And frankly, they have commercial real estate managed down below 5 or 7% of their balance sheet. And so we're not thinking that there is going to be a banking crisis writ large on commercial real estate that causes an accommodative Fed, right? And as a taxpayer and an American taxpayer, that's, I think, comforting, right? We don't want to see what has happened historically, which is the U.S. taxpayer has been required to bail out the big banks. I think that there has been, as a free marketeer, it's hard to say. I think that there's been good prudential regulation, but frankly, that's the case in our minds, right? We think that the banking system writ large is healthy with the caveats, right? And the caveats are that the banks below the top 50, and certainly a lot of the regionals, super regionals, and even the small banks do have some material concentration, upwards of 50 to 70% of their balance sheet in commercial real estate credit, right? And we think that that's unhealthy, right? It's a fundamental mismatch in assets and liabilities. It happened, at Silicon Valley Bank. It happened, to the signature banks where, long dated assets, short dated liabilities, credit crunch, right? That, I still think we have to see some of that play out. And we really haven't seen a whole lot of that play out. And so, hearkening back to your last question, what's happening broadly, that's got to come into play to some extent. And how those banks respond will be, I think, a big part of the story. And thus far, it's been extend and pretend, right? And while that has kind of been the playbook for the last couple of crises that we have been through, they were also coincident with this accommodative Fed, right? And because we're not seeing an accommodative Fed, at least we don't believe we're seeing that in the current, certainly not currently, and probably not in the short to medium term, right? We're seeing the extension of these credits, I think, going to cause even more deterioration in asset value. So why is that, right? Why is that? Well, because if we're going back to the last crisis and you had an asset that had liquidity or cash flow problems, right? And you extended that loan, and that loan was back then LIBOR, but a SOFR plus 300 loan. It's a pretty standard real estate loan, right? Well, SOFR or LIBOR was 0 or 1%. So your total cost of capital was 3 or 4%. So if you're generating 3 or 4% cash on cash return at the asset, you're able to service that debt. And frankly, you were probably generating 6 or even 7% cash on cash return. You were able to both service the debt of the asset in the extend and pretend and have 200 or 300 basis points of excess cash flow to invest in the real estate to attract and retain tenants. That's not happening today, Paul. What's happening today is the extension comes at a 6 or 7% coupon on the loan, which is sucking up 100% of the free cash flow from the asset, leaving no money to go back into the asset, to re-tenant the asset, or to put tenant improvements into the asset, to create this live animal that is a commercial real estate asset, to create value. And so that has to be a problem as we continue to go down the road, because every day that passes isn't a recovery of the asset. It isn't investing in the asset. It's a deterioration. And at some point you got to replace the roof. And at some point you got to do new carpets. And some point, you got to actually spend money to attract a tenant. And if that doesn't happen, we're going to see continued deterioration. And I don't know where that cash is coming from in a 4.5%, rate environment.
Well, Toby, let's turn to a few of the finance categories that your shop specializes in. For example, do you expect demand for senior, for mezz, preferred equity to stay where they are right now? Or are you seeing some movement in interest from sponsors, more demand from sponsors in some of those products?
Well, I guess I would say that if you have a developer out there who can imagine a project, he or she will try to seek financing for it. And if they get it, they'll build it, right? It is among the most undisciplined lot in the planet, right? So if we're putting it on the developers, I'd say, that there is a fairly consistent demand for product. That's a little cheeky and trite, because for sure there is a hesitancy to invest in development today, and only really special projects are getting financed in construction, right? And when you kind of go across the gamut, it's different, right? In office, it's super special, right? We just did a construction loan, but it was, A, in Miami, B, it was across the street from one of the most successful, if not the most successful mall in America, right, in Bal Harbour Shops, right? It's across the street from the brand new entrance being built at Bal Harbour Shops, right? It is, on the water. It's got water access with, docks. It's a boutique. It's only 80,000, 75,000 square feet. It's built for boutique tenants that might be the kind of people who live and want to work in an environment like, North Miami Beach, right? It's right next door to Indian Creek, the billionaire bunker, where it'll be the closest physical office building to that community, right? So it's a super special asset, right? And so yes, we are financing a new build of an office building, right, which is unique, right? But I'd say that that's a big exception to what's happening in office today versus the norm, right? And on the other side of the spectrum, right, we see tons and tons of money going in to build data centers, right? And data center, has to be among the most prolific developments going on in America today. And there's clearly a massive demand for data center. And it's complex. You got to make sure you understand the power, and you got to make sure you understand whether it's a co-location facility or a single tenanted facility. There's lots going on in that space. And, I can't say that, we've done a whole lot, but, we're watching this carefully, because there's a ton of money going into data center development, right? So on two sides of the spectrum, office versus data center. And, frankly, in between, there's, very, very little retail getting built, right? Certainly, retail and grocery anchored retail, drive to necessity retail, I'd say is probably the best performing asset in America, right? And, we just financed, frankly, a ground up grocery anchored retail in Southern California. So I can't say that. Anyway, I feel like, it's going to be so specific. And frankly, that's really the story, right? The story about commercial real estate continues to be, and maybe even more so today than ever, it is a wildly idiosyncratic asset. And one asset on one corner might behave extraordinarily different from a similar asset across the street or down the street. So, we have offices at Park Avenue and 56th. And it used to be the case if you said, Park Avenue, it's great.
Mm-hmm.
Right? And there was just no shot that you were wrong, right? Park Avenue is a no miss. And I will tell you that I think that Park Avenue is about as competitive as it's been in a long, long time. We actually are looking to expand our space a little bit. And, frankly, I have a hard time finding a Park Avenue address that accommodates our little firm. And it's not a lot. I mean, we 7,000 square feet. So, but I'm really active right now on Park Avenue. And so I kind of can give you one really kind of funny and odd perspective. At the corner of 56th and Park is our building that we're in today. It's 430 Park. And, excuse me, it's a boutique building. It's kind of an ant farm. There's a lot of small tenants. It's 100% occupied. And I think the building is a $115 a square foot building, right? And it's full. Immediately across the street is Ken Griffin's New York headquarters, brand new building, 425 Park, right? And it is also reported to be full. And the rent there is reported somewhere between $250 and $300 a square foot, right? And I had then the interesting kind of coincidence that one of my friends was moving into that building, right? And I went to him and I said, hey, what are you really paying and do you think the building's full? And he said, oh, the building's full for sure, right? And he said, and honestly, I don't really know what we're paying. This is a CEO. And I said, really? And he said, yeah, that's the building that I wanted to be in because that's the hedge fund building where I wanted to be. And so, of course, I told my people to get the best deal that they could get. But it was that special building that ilk of investor wanted to be in. And the dollars per square foot was not the pivotal decision for that. And I think, frankly, that's the same story for One Vanderbilt or some of the other super unique buildings that we hear a lot about in the press. It's that building that is attracting that tenant, and that tenant is just far less sensitive about what rent is and far more concerned about being in the right building, right? And having the right access for its employees. And that line item for them just doesn't come up at the top of their cost concern, right? Making sure it has the right power, the right tech, and the right visual delivery for their clients was more important than the dollars per square foot, right? And then just on the same block, Park Avenue and 56 on the northeast corner, right, is a building that it's a yellow brick building, and it has about 10 floors, 8 floors that are sandwiched in between the ground floor retail and a residential condominiums above. And I look at it at night and I swear it is empty, unleased. But it's a 1970s 8-foot ceiling height building that just cost to deliver for a tenant doesn't make any sense because the tenant won't pay because it's 8-foot ceilings and they're like, that's a $50 building and I don't want, I don't want to be there. And you're going to have to make it so much nicer and you can never make the ceiling height any higher. But the residential above makes it such that you can't raise the building. And so that building is stuck in some sort of purgatory, right? That historically wasn't the case. I don't know if Park and 56 is just so good of an address that someday people move into that 8-foot clear height office space, but it's empty today in a Park Avenue that's darn full. So that story of the three tails, right, is really the story of commercial real estate broadly, right? It is a wildly idiosyncratic asset class. And if somebody tells you, what do you think of Park and 56? You better know that there are 3 kinds of real estate on Park and 56. Good, extraordinary, and very, very tough.
That was part 1 of my conversation with Toby Cobb of 3650 Capital. Please stay tuned for part 2 coming soon. Before you go, let me tell you about an exciting opportunity. The CPE Executive Council is a group of industry leaders who exchange ideas about trending real estate issues. Highlights of their discussions are posted on our website and featured in our newsletters. If you're interested in joining the council, please contact CPE's editor-in-chief, Jessica Fear, at jessica.fear@cpe-mhn.com. That's jessica.fiur at cpe-mhn.com. You can find archived episodes of Investment Matters and more CPE podcasts on Apple Podcasts and on our website, commercialsearch.com. Until next time, thanks for listening and be well.